Someone just asked about Waste Management, WM, and Trader Moe's just saying it's basically way overpriced, which it looks like on its stock ticker already.
Why is it overpriced?
I'm sorry. It's as high as it's always ever been at the moment.
It's overpriced.
Well, that's true, Paul.
And it's not the highest it's ever been.
Do you want to look at it? Sure. You want to look at the Waste Management?
All right, guys.
Let's look at it.
Basically, it's a $50 billion company. It's paying a 1.9% dividend, so let's call it $1 billion per year they're going to pay in dividends. So remember, we want to make sure that the free cash flow can support the dividends.
How's the PE ratio?
Awful, 33. So already sounds overpriced there. Profit margin, barely a check, but it's there, 40% gross margin. So we have 1x, one check, 32 PE, $1 billion in dividends. That's the quick recap off this main page.
Revenue growth, pillar number 3.
I bet you this is going to be very low revenue growth.
Really?
Better than I thought. 13, 15.5. Check with consistent growth every year. A company like Waste Management will be buying a lot of smaller town smaller trash companies within a city. So if a trash company builds up and they generate $10, $15 million a year, they're going to start buying these guys and adding to their portfolio. So there's a check here for this one. It's done about, what is that, $2.5 billion on, so 20% growth over the last 5, so 3 or 4% growth a year.
Profit growth over the past 5 years?
Profit growth, 753, 1.67, check mark there, over double. So they've over doubled their profit though. And by the way, let's go back to operating income. Now here's the deal. Here's where we look at operating income. It went from 2.1 to 2.75. Remember, operating income is the profit they make before interest and taxes on their actual business. It's only up 30%, yet their profit has doubled. So keep that in mind. Why is that happening? You want to understand why is their business operations, there must be some financial engineering happening. Maybe less debt or they're getting lower interest on their debt, something like that, because their operating revenue is only up 30%, yet their profit's doubled. There might be some other income items in there. This shows you how the business is actually doing from a proper profit perspective from the operations of the actual business. Number of shares outstanding.
Pillar number 5 is number of shares outstanding. We want this going down.
It is going down. 452 to 424. Check mark.
How about current assets greater than current liabilities is pillar number 6.
Let's check it. Let's check it.
Dave, I see you.
Look how much better this is now that we use my laptop. Remember how slow it was on there?
Yeah, you're doing great. Lots of questions still coming in, guys.
3.36 versus 2.8. So they have enough by $500 million to pay their current bills.
Okay, that's nice.
And then now the favorite, free cash flow.
Free cash flow growth, pillar number 7, y'all.
Okay, ready? 1.3 to 2. Check mark there. 1.7, 1.6, 1.8. You ready? So that's 3.
I'm done.
6.
Divided by
4,
5. It's 1.68.
8.4 divided by 5.
1.68.
1.7 times 20 equals $34 billion. I would not pay 20 times on this one because it's a slow growing company. Call it 15 times 1.7 is 25 billion roughly. What's it currently selling for? 50 billion? Yeah, cut it in half.
Really?
Yeah, cut it in half. Guys, it's growing, but it's not growing a ton. It's growing 3 or 4% a year in revenue. You saw the operating income was only growing 5 or 6% a year. I mean, you have to get your money from somewhere. And if you're just banking on somebody else paying you more money, that greater fool theory, it's not going to work. Over long periods of time, it's going to be reflective of the cash flow. Now, granted, their cash flow last year was $2 billion, so you could argue that 50 billion divided by 2 billion is 25 times. But I want to go for longer periods of time to take out fluctuations in cash flow here and there. So maybe you pay 40% less, maybe you pay 30% less, but it's not where it's at today. I'm not buying it today at this price.